Welcome to Bloomberg ETF IQ Europe. I'm Francine Lacqua. Over the next 30 minutes, will be your guide to the region's thriving market in exchange-traded funds. Well, everything you need to know about the funds and the flows. Still shining, 8 of the 10 best-performing Europe-listed ETFs last week were focused on gold. We'll ask if bullion can keep on climbing. European ETFs crossed the $1 trillion mark for assets under management. Despite record highs for the U.S. stock market, equity inflows have underperformed fixed income. We'll ask why. And after a slow start, actively managed exchange-traded funds are taking off, with more active launches this year than passive. We'll discuss how high they could fly. Well, good morning, everyone. Let's start the show focusing on gold. Of the top 10 best-performing exchange-traded funds in Europe last week, no fewer than 8 were gold-related. Now, the market access Gold Bugs ETF, which invests in companies involved in gold mining, rose more than 8% over the period. Despite that, gold holdings in ETFs backed by bullion snapped a 20-week streak of increases, registering a weekly drop. Joining us now to discuss all of this is Krishan Gopal. He is from the Market Intelligence Group at the World Gold Council. Krishan, great to have you on the program. So you also have a new ETF. What was, behind the decision?
So I think what we've seen in ETFs this year is tremendous interest, and that's been backed up by the inflows that we've seen. So we've seen a record level of about 900 tons to the middle of August, taking a total AUM in these products to around 3,800 tons. And this has really developed for over the last 15 or so years, and the kind of the environment that we're seeing currently has really highlighted the benefits that gold can play. So we've seen 3 key drivers for the investment inflows that we've seen this year into these products. Firstly, we've seen the increasing need to hedge risk, the mounting expectations that the economic recovery is likely to be a U or a W shaped rather than a swifter V shaped. Speedy recovery is likely one that will create an added uncertainty over the coming months and years. And also the resilience in the equity market rally that we're seeing currently is posing questions for investors. The second key driver was the ultra-low interest rate environment that we've seen, concerted expansionary policy from both governments and central banks has really helped to lower interest rates, and that has brought down the opportunity cost of holding gold for investors, and also increased the potential role that gold can play as a future inflation hedge. And finally, it's also the price momentum that we've seen this year. So gold is around 30% up for the year, or just under that, and that itself has brought in added flows as we continue to see the rally progress.
Krishan, is there anything, as too many gold ETFs?
Well, I think what we've seen around the world is that the demand that we've seen is actually led to more products, absolutely, and there has been increased competition. But at the moment, we continue to see demand outpace, new products, and we're continuing to see inflows, and I don't see that abating anytime soon. Yes, we will see added competition. We will see, costs go down, management fees will continue to be potentially competed. But at the moment, no, demand in gold ETFs is remaining strong, and the drivers that we've seen leading to those inflows so far this year look like they'll persist for some time yet.
Krishan, if you look at flows in gold ETFs, do they tell us, when you analyze them, do they tell us if people want to hold it, longer term or shorter term? And does that give us a sense of the risks that people perceive out there in the markets overall?
Absolutely. I think what we've seen in this year in particular with the inflows that we have seen is that there is a growing interest in a strategic holding to gold, not just a tactical one. And that's come over several months, and that's also due to the environment that we're seeing, as I mentioned, with the low interest rates, the heightened uncertainty, and question marks about the future and the length of any potential economic recovery. So I think, yes, we have seen investors kind of recognize the role that gold can play in this kind of environment, and not just at this moment, but potentially going forward as we kind of look to see how the impact of the coronavirus pandemic plays out, not just over the next several months, but potentially even longer.
How many of these funds are actually backed by physical gold?
So of the 80 or so funds that we track on our Gold Hub website, we look at those that are purely backed by physical gold. And normally that's in the region of anywhere between 90 and 100%. So the vast majority of these products are backed by physical gold.
If you look at the ETF gold markets, I mean, some would say that it just makes it a lot more volatile, the gold market more volatile. I mean, you know, if we didn't have these ETF or gold ETFs, would the gold market actually look very different?
I think it would look different in that it's an element of demand that wouldn't be there. I think what we've seen is actually the increased demand this year, and not just this year, but for a number of years, has actually meant that there isn't a kind of a demand for these type of products. I think they make it much more accessible to access the gold market, improve the ease at which people can come in and out, and actually, you know, add to the liquidity of the gold market. And again, as I said, the inflows that we've seen this year, around 900 tons globally, show that actually this is something that the market wants, and it's become a huge element of demand that we see on an annual basis.
Krishan, when you look at, you know, the gold is doing well at the expense of what other ETFs, and it's unclear to me, you know, given who we speak to in terms of investors, whether the bulk of gold positioning is a protection against inflation or investors being afraid of deflationary pressures.
Well, our analysis has shown that actually gold will work in both situations. But what I think the question marks at the moment kind of suggest is that there's just a general lack of certainty around what may happen. Yes, absolutely, people are asking, rightly so, what does the future hold, given the expansionary monetary policy and the fiscal stimulus that we've seen could lead to, and the risk that may bring, and the ultra low interest rates I've already mentioned. So I think it's reasonable to think that this uncertainty has led to some of the flows that we've seen, not just in ETFs but in gold more broadly. And I think going forward, it's likely to be the case that this will persist for some time yet. We seem no closer to knowing the full outcome or the economic impact of the pandemic, and governments continue to adopt a relatively easy stance in order to support these economies. So for the time being, at least, it seems very much that the drivers that supported gold investment that we've seen in the first half of the year are likely to continue.
Christian, when you look at ETFs and positioning for the future, I don't know whether there's a technical lever for gold which actually would, you know, mean a sell-off in ETFs. For those of us watching at home, or for those viewers watching at home trying to understand a little bit better the gold ETF market, are they supported by technical levels?
Well, we don't necessarily look at the gold price in that way. I think what we tend to look at is more the fundamental drivers, and as I've said, there are many which are kind of propelling this ETF investment that we've seen, particularly this year, the record levels of 900 tons so far. So I think the gold price is reflective of many of the drivers which have been driving the ETF demand, and you know, there is a good reason why it is where it is.
Christian, thank you so much for joining us. We'll have plenty, of course, on gold. It's great. Actually, I was looking, I didn't know this, but I went on to the World Gold Council, and they have, you know, global demand trends for Q2, and I think that's available to everyone. So that was our great guest looking at gold, and we'll have plenty more, of course, on gold throughout the day. We continue, of course, more on ETF. Coming up, active ETF launches look set to overtake passive launches this year for the first time ever. We'll discuss why investors might want to add active to their portfolios. This is Bloomberg. This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. Now let's discuss one of the biggest ETF trends of 2020. Launches of active exchange-traded funds look set to overtake passive launches this year for the first time ever. In the US, the trend has been aided by a new SEC rule approving non-transparent wrappers, allowing stock-picking ETFs to keep some of their strategy private. Well, joining us now on the phone is Athanasios Psafarigis from Bloomberg Intelligence. Athanasios, thank you for joining us. Why the sudden interest in active ETFs this year?
Hi, Francine. Good morning. Sure. So one thing you just alluded to, I think there's two things. One is regulation and the other is performance. And like you had mentioned, this new SEC rule has been fully implemented this year. And what it had done, it was started last year, but the biggest difference was that it treated active and passive ETFs similarly. And what it does is it makes active ETFs even more tax efficient than they were. And the other piece of regulation was this approval of non-transparent ETFs. And this was a big hindrance for a lot of the traditional active managers who wanted to jump into the ETF landscape because they were really reluctant to show their holdings. This new structure was approved, so you're seeing a really big uptick now in active launches, and in fact, you're seeing new participants jump into the market that weren't in here before. T. Rowe Price, Federated, DFA, these are all really big active shops in the U.S., and they're starting to jump in. And the other component is performance. If you look at the top performing ETF in the U.S. this year, it's an active fund. So I think the uptick in launches and the passing of regulation coupled with the really strong performance this year is drawing a lot of attention to the area. And I think that's why you're starting to see a pickup in flows in some of these big active ETFs.
So, Athanasios, what are some of the key reasons European investors might want to look at these?
Sure. So in the U.S., there is, to draw this parallel, there's a very big tax advantage to the ETF in the U.S. And this is even if you don't believe in active or you don't like the strategy, you already will gain because of the tax advantage. In Europe, this tax advantage is not really there, but there are other benefits, I think, to the U.S. and then, in Europe. And the volatility we saw in March, I think, really highlights this. And I think what's the important benefit of the ETF structure is it isolates activity from other shareholders. So what I mean is what we saw in March, we saw a lot of property funds, UK property funds lock up. Why did they lock up? Because there was a lot of early redeemers in these funds, and they end up locking up anyone who's still left in the fund. What an ETF does is essentially it isolates the activity from the other shareholders. And I think this is really key. So let's say if you want to get into a fund or get out of a fund, you're not impacting shareholders that are already in the fund. And the same thing with transaction costs. Every time a new creation or redemption comes into a mutual fund, they have to go out and buy the securities. That cost gets passed on to the shareholders. The ETF isolates that, and I think that is one thing to consider when looking at these active ETFs. Okay, sure, I don't have the tax efficiency, but I have more efficient and isolated way to get in and out of this fund without impacting other shareholders.
Athanasios, thank you so much for all of the update. Athanasios Psafarigis there from Bloomberg Intelligence. Up next, flowing into bonds, fixed income ETFs have taken in more than 3 times as much money during the S&P rally as equity funds. More on that next. This is Bloomberg. This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. Now, assets under management by ETFs listed in Europe have crossed the $1 trillion mark. Despite record highs for the U.S. stock market, though, equity inflows have underperformed. Since the March bottom, fixed income ETFs have actually taken in more than 3 times as much money during the S&P's rally as equity funds. Well, joining us on the phone is Andreas Zink, head of Switzerland and Liechtenstein managing officer at Vanguard. Andreas, great to speak to you. Thank you so much. Why this appetite? What will happen to active versus passive in the next 12 months?
Thank you, Francine, for having me. So I think the discussion active versus passive is kind of a discussion of the past. It's more a question of high versus low cost, and a lot of investors have actually realized that costs is the main driver of return, and they have decided to allocate more assets, be it active or passive, into low-cost vehicles, and that's actually why ETFs have benefited so much in the last 2 years with tremendous growth. You mentioned it, above 1 billion. That's the result, and the future looks bright. We think the growth will continue with about 15 to 20% per annum. So we could go as much as 2.5 up to 3 trillion, depending on the market performance, in 2025.
So, Andreas, if you look at some of the flows in ETFs, what are the big trends? Is it just that everyone's running into gold and kind of forgetting equity ETFs?
It's actually the trend discussion for once is a bit boring, I would say, because there are no new trends. The trends we are seeing, and you mentioned some of them, are old trends. So first and foremost, we have to mention fixed income ETFs. You mentioned it, the asset class in the fixed income market with the highest inflows dominated the market. A few years back, fixed income ETFs were not really relevant in the ETF market. It was pure equity and, to a certain extent, commodity game. This has completely changed, and we have seen massive inflows this year, potentially because the Fed and other central banks started to buy bonds and ETFs, fixed income ETFs. We have seen even higher growth. But for me, it's also kind of a good thing of Corona crisis is a bad thing, but a good thing of the Corona crisis is actually that ETFs, and in particular fixed income ETFs, could actually prove that they hold what they promise. And for me, ETFs are kind of heroes of the crisis because they delivered what they promised. There was always liquidity. It came with the price tag, which is very clear, but they actually delivered on the promise, and they were always tradable at reasonable costs, very transparent. So this is why we see so much more in fixed income ETFs. And the other trend I would like to mention is sustainable ETFs. It's incredible this year. You mentioned it, ETFs in equity, low flows, but sustainable ETFs are on a run. We have seen year to date about 17 billion inflows in that relatively new category.
Yeah, and I want to talk a bit more about ECG ETFs. See, Andreas, you tell me it's boring, but then you tell me they're also the heroes of the market, so it's not boring at all. We'll get back to addressing Vanguard shortly. Now, let's look at, there's an ETF for that. Every week, we dig down into some of the big trends in exchange-traded funds. This week, here's Anne-Marie Hordern with, there's an ETF for that. Hi, Anne-Marie.
Good morning, Francine. Well, this week there's an ETF for that. We're looking at all of the stocks that are really exposed to the work from home sector. We are working from home, we're shopping online more, we're even socializing virtually, and we are seeing massive inflows into thematic. Thematic ETFs track gaming, internet, and cloud computing. And as you can see here, these really are starting to heat up in terms of these inflows. They are set to drive record inflows for the category, assets to more than $70 billion. And Bloomberg Intelligence says they expect issuers to keep introducing products that could eventually push thematic to the #2 size among ETF sectors. And so far for 2020, thematic ETFs had added $11.3 billion. So in this pace, we can really far outpace the 2017 record of 11.7 ETFs. And just quickly, Francine, if we dig into one of those specific topics, I want to show you cloud computing. This one ETF, Wisdom Tree Cloud Computing Fund, they have the names like Zoom, which pushed the NASDAQ 100 overnight into a fresh record. They also include DocuSign and Shopify. Look at it, absolutely just flying above the SPY. That's the S&P ETF, outperforming it. And we also see these massive inflows. So obviously, investors that don't want to just take on a specific exposure to one company, but want to get that work from home exposure, are really flying into these ETFs.
Anne-Marie, thanks so much. Anne-Marie Horduran there with a full wrap-up of some of the trends there. Anne-Marie basically described my life. It's shopping online, staying at home, not going out. Let's get some final thoughts from our guest this week, Andreas Zing of Vanguard. Andreas, we were talking a little bit before about ESG. How much more, if you look at the European ETF market, it's definitely not as mature as the US market. Will the pandemic and what we've seen on the other asset classes mean that the European ETF market will mature more quickly?
I guess so. I think it's always difficult to compare Europe with the US because in the US there are several factors in play which are not relevant in Europe. For example, pension saving is a thing which people typically rely on the government and don't self-invest. So there is a lot to do in the European ETF market to bring it at the same level as in the US. But nevertheless, I think we see tremendous growth. We will continue to see tremendous growth because ETFs are just a fantastic instrument, and they make low-cost investing, they democratize low-cost investing, and everybody has access, so you don't depend on a distributor who kind of puts that ETF in your portfolio. You open a brokerage account, and you can buy those ETFs. Costs have come down. That's tremendous. But I think, as I said initially, it will take a few years to catch up with the US.
Andreas, very quickly in 20 seconds, what's most exciting out there? Is it ESGs or is it these trends on working from home that you can buy through ETFs?
Yeah, I mean, I was actually disappointed that you didn't pick a Vanguard ETF as an ETF of the week. No, I think what is really exciting, what excited me, as I said initially, in the Corona crisis, we had a perfect storm. Nothing was liquid except for two instruments. One was government bonds, and the other instrument was ETFs. And that excited me very much because everybody kind of was waiting for that perfect storm to happen, and everybody challenged us, the industry, whether ETFs are liquid in such a market environment, and they have delivered on the promise, and that excited me. And a lot of people have seen it, and they will shift assets from single lines, from actively managed funds, from other instruments, futures, for example, into this great instrument,
Andreas,
ETF.
Thank you so much. Andreas, thank you so much for your insight there from Vanguard. Well, that's it for Bloomberg ETF IQ Europe.